Now in 2021 so far, we've seen some mega trading of stocks, especially meme stocks like Gamestop, and that for a lot of new traders has thrown up some new confusing terminology, words like short squeeze and going short. And in this video I'm going to look at what going short means, and on its flip side what going long means, and I hope that will then clear up that problem. Hello, I'm Stephen Hode, trader and founder of TheStopHunter. Now, to understand the concept of going long or short, we've got to take it back a few steps to fully understand what we're doing here. Now, as we know, prices of anything can go up or down, especially stocks. So if we're sticking with our GameStop popular stock so far of 2021, we might think for whatever reason that the price of GameStop is going to go up, or vice versa. We think GameStop isn't a very good company, and actually we think the stock price, share price of GameStop is going to fall, i.e. go down in price. So if we have a point of view that the price is going to go up, we call that going long. And if we have a point of view that the price is going to go down, then we call that going short. So that is the first concept idea that you have to get in your heads and get straight. So going long is when you think the price of an asset or market you're trading is going up. Going short is when you think that the price of whatever you're trading is going to come down. So just clearing up some further terminology, you might hear market experts and analysts saying, oh, the market is bullish or the market is bearish. That translates to our long and short theory as bullish is going long and bearish is going short. So if you have a point of view that something is going down, you might hear them say, well, it's a bearish trade. That means a short trade. So just another bit of terminology to clear up there. So now this is the bit that really confuses most new traders. It's the actual concept of going short. Long is simple. People understand that if you buy something at a certain price and it goes up and you sell it, you make money. What is difficult to comprehend is if you sell something before you buy it, people start getting mind muddled and saying, well, how can I possibly do this? For most of us, if you trade CFDs, spread bets, all you need to know is you can actually do it. Okay, so you don't have to worry too much about the complexities. But if you're a stock trader, it's quite important to know the process because it can be costly, and you'll also understand concepts such as the short squeeze more easily. So let's take a look at a few examples just to try and get the idea of going long and short more clear in our heads. So going long in our example there means you are buying a contract, whether that's an FX contract, a stock, a share, a commodity, whatever it is. But in this example here, we have bought whatever it is at 60. Okay, we hold it for 1 week, a month, whatever that time period, and it gets to 100. We close out the trade, and what have we made? 100 minus 60, we made 40 points on that trade. Now the flip side, the going short example, is, well, we find an asset, whether that again be a stock or commodity, we think the price is going down for whatever reason. We've done our fundamental analysis, our technical charts tell us that now is the time to sell. So we've got our example at 100. So we sell now before we bought it at 800. So just remember, because we can do it. Okay, so we sell at 100, then over the next week, 2 weeks, 3 weeks, it gets down to 60, we can then buy it back at that 60. So if we've bought something for 60 and we sold something a few weeks ago, whatever time period it was, at 100, we've actually still made 40 points on that trade. So exactly the flip side of our long example, the going short example there, making the same amount of money but with a different point of view on the direction. So this is the really important bit to get into your head to understand what going long and going short means. Now, like I said, the practicalities behind going short are far more complex than the going long side, and we are going to briefly touch on those, especially around the stock traders. What is the process involved there? Because you can't, in reality, in let's say the stock world, just go short. You need to do a few things. So I'm going to talk about that now. So let's talk about the practicalities of selling short, especially in the world of stocks. How would you actually go about doing it? Well, you're going to have a broker account to start with, and you're going to go to them to be able to do this. So I found my Gamestop. I think I want to sell them short. I go to the broker and I open a position by borrowing the shares from the broker. Okay, and I'm going to try and make money or speculate on my trade by going short, because I still think they're going to go down. And then when I think they've moved down enough, if I'm lucky and my decision making was correct, I then return them to the lender, i.e. the broker, who will then buy them back from me. Okay, so just a little thought, I'm not going to go into too much detail here, is then you can start seeing how a short squeeze might work. What if, for example, especially in an illiquid stock, a stock that hasn't got much trading volume, what if there is no one to buy them back? You know, what happens to the share price then? Something to think about. Okay. The other thing you've got to realize is that going short is quite risky because it has an unlimited downside. Because if you're going short, someone's going long, so if the price still keeps going up, you're going to lose, and theoretically, you know, there is no, you know, upside to where that, you know, that stock price could stop. So a risky process, but it is great for speculation, especially if you think things are going to go down. Now, you can't go short on everything, and brokers may not allow you to go short on certain markets, but to be able to do this, you're going to need a margin trading account. Okay, and you're going to be paying interest on the value of those borrowed, you know, stocks and shares when that position is open. So there's a cost there, and you're going to have to maintain that account with no, well, in technical terms that's known as a maintenance margin. And if you fall below that maintenance margin, you're going to have to top it up, and you're going to need the funds to top it up. And if you haven't, you can be closed out of that position. So there is a bit more to it than just, you know, you can go short. Hopefully that's given you a little insight into how stocks can be traded by going short. And one last thing to think about of short selling is that, you know, it gets a bad rap in the press, but actually it's a very useful tool for hedging a long position. Now, hedging is not for this video, and maybe you want to look into it separately, or if there's the interest and you let me know in the comments below, I can do a short video on how that works. But basically the short selling as a hedge process is negating the risk of a position, a long position that you hold, and therefore is a very good risk management tool. So there you go. I hope you now understand the concept of going long buying and going short selling. It really does make sense once you spend a few minutes thinking about it, and the great thing is you can apply the going short, you know, strategies to your trading, and then that will double up the amount of opportunities you've got in the trading world and present you with new opportunity to trade with. So If you've liked today's video, please give us the thumbs up, and don't forget to hit the subscribe and bell buttons to receive any future notification of content I'm going to produce. And all that's left for me to say is thanks for watching, good luck with the trading, and I'll see you in the next video.